Adobe stock is shockingly cheap right now. That's why I'm buying back in after previously selling my position. In this video, you'll learn how Adobe really makes money. I'll break down Adobe's moat, fundamentals, and investment risks. I'll also reveal my Adobe stock valuation towards the end. I currently hold roughly $500 worth of Adobe stock. This means that Adobe stock makes up around 5% of my eToro portfolio. So what does Adobe actually do? They have countless apps and everyone's heard of PDFs. But in summary, Adobe has developed an ecosystem of apps used by creative professionals. These creative professionals often use Adobe's apps on a daily basis as part of their workflow. Clickbait headlines may have you thinking that Adobe is losing customers to rivals like Canva, but that's a misunderstanding. Adobe and Canva serve two distinct demographics. Adobe is suited for creative professionals and enterprise customers, whereas Canva is more suitable for casual creators. This is the reason why Adobe can charge so much for access to its ecosystem, whilst Canva's 170 million users access their tools for free. Adobe's revenue is concentrated in fewer high-value customers, whereas Canva's revenue is spread across millions of low-value customers. It's a bit like how Ferrari serves ultra-high net worth individuals, whereas Toyota serves a mass-market consumer base. But what about Adobe's moat? How do they protect their huge profits from ambitious competitors like Canva? Adobe's most powerful competitive advantage is its high switching costs. Switching costs are the frictions, losses, or inconveniences a customer experiences when moving from one product to another. Learning to use Adobe's products like Photoshop, Illustrator, and Premiere Pro takes years. Once someone masters them, they don't want to relearn a new tool. This is why professionals rarely leave Adobe. Imagine a company with 10 employees that all depend on Adobe software to make money for the business. The idea of them switching to an Adobe competitor is ridiculous. It would take too much time and could even hurt the company's bottom line. Why would a company even think about taking this risk? It's just unnecessary. Professionals don't just change their entire workflow to save a couple of dollars a month. Imagine a creator making $100,000 a year with an Adobe subscription costing $1,000 a year. They're not just going to switch just because Adobe raises their price by $100 that year. It just wouldn't be worth it. Speaking of raising prices, pricing power is another competitive advantage that Adobe has. Pricing power is a company's ability to raise prices without losing customers. Even if Adobe's user growth slows, they can grow their revenue by raising prices. Pricing power is an especially attractive competitive advantage because it costs nothing to raise prices, meaning that extra revenue almost entirely falls to Adobe's bottom line as profit. This extra cash can then be reinvested by the company or returned to shareholders through share buybacks. Adobe has raised prices by 3 to 5% annually over the past decade. This is why revenue continues to compound despite competition fears. So now that we understand Adobe's business model and moat, let's take a look at the fundamentals to see if the numbers agree. Adobe's revenue sits at $23.8 billion in the last 12 months. You can see that in the last 10 years, revenue has grown at an annualized rate of 17.4%. This growth in revenue has slowed to 13% over the past 5 years, and then to just over 10% more recently. I think this could be one of the reasons that the market thinks Adobe is being disrupted. However, I think it's more reasonable to assume that Adobe is just maturing. There's only so many high-value customers out there, and the market would hate Adobe even more if they decided to chase revenue growth to the detriment of profitability. Adobe's revenue could slow further, which would upset the market. But I'm focused on the company's free cash flow growth because that's what we use to value the business. Looking at Adobe's free cash flow tells a different story. Free cash flow grew 26% in the last 12 months. This is all while the company's stock fell over 32% in the same period. So Adobe's underlying profits are booming whilst the stock price is collapsing. If you've ever seen a more obvious disconnect, let me know in the comments. And then if we look at Adobe's free cash flow per share, we can see even more impressive growth of over 31%. That extra 5% comes directly from share buybacks. As you can see here, Adobe brought back almost 6% of their total shares outstanding in the past 12 months. Share buybacks are when a company uses its cash to buy its own shares back from the market. This benefits existing shareholders because their overall ownership in the company increases. Share buybacks are like dividends, but rather than paying the cash directly to shareholders, it's invested back into the stock, avoiding any potential tax charges. Adobe's price increases should reflect in the company's profit margins. If we take a look at their operating margin over the past 10 years, we can see that it's expanded from 22% all the way up to 36% today. This is a clear indication of Adobe's pricing power. Now, if we take a look at Adobe's balance sheet, we can see that the company has $6.6 billion in cash, compared to $6.2 billion in debt. That means Adobe could pay off all of its debt right now if they wanted to. A very strong position to be in. However, Adobe's debt has actually been rising, which looks concerning on the surface level. But Adobe actually uses this debt to fund share buybacks. This might sound like financial engineering, but it actually makes a lot of sense. Adobe invests its excess cash in research and development to stay ahead in the AI race. The company can then borrow to fund share buybacks, especially when a stock is undervalued. Adobe can then borrow at 5% and buy back its own stock, which compounds at 10 to 15% long term. This is totally rational, and many companies follow this model. But what about the risks? What should we be looking at as Adobe shareholders? Competition is always something to pay attention to. As discussed, fears around Canva taking market share are somewhat overblown. However, if Canva decided to compete directly for Adobe's high-value customers, it would cause more uncertainty around the stock. The market is currently pricing in the risk of Adobe's ecosystem being replaced by AI tools. I find this outcome unlikely. Adobe's ecosystem moat can't just be vibe coded away. Actually, AI is creating new opportunities for Adobe. Adobe is trusted by enterprises to provide solutions that meet compliance requirements. Adobe's new AI tools have been developed specifically to avoid copyright infringement. This reduces liability risk on the customer's end. So with the risks out of the way, let's focus on the part you've been waiting for. Valuation. Adobe stock is down over 37% from where it was 5 years ago. The current PE ratio is shockingly low. Adobe's forward PE ratio is 12.5. The company's PE ratio adjusted for 2027's projected earnings is just over 11 times. Salesforce, which is growing slower than Adobe, has a forward PE ratio of 16. Microsoft's forward PE ratio is currently sitting at around 24.5. Even on a free cash flow basis, the company looks cheap. Having previously traded at a free cash flow yield in the 2 to 3% range, Adobe currently trades at an 8% free cash flow yield. The higher the free cash flow yield, the cheaper the stock, and vice versa. Now let's head over to the DCF calculator on Qualtrim to calculate what kind of return Adobe stock could provide if bought at today's price. We've got to come up with some reasonable assumptions for Adobe's free cash flow per share growth over the next 5 years and the free cash flow yield that we expect Adobe to trade at. I think it's reasonable to assume Adobe's free cash flow per share will grow at around 15%. Adobe's 10-year average is 24.5%, with growth recently re-accelerating. So 15% seems reasonable to me. Now all we need is an appropriate free cash flow yield. As discussed, Adobe usually trades at a free cash flow yield between 2 to 3%. Due to the stock's recent poor performance, it currently trades at 8%. I think a 4% free cash flow yield is reasonable for Adobe stock long term. This is higher than the long-term average and consistent with the valuation of other mature companies. So based on these assumptions, Adobe stock should return 32% annualized over the next 5 years if bought at today's price. These are astronomical returns, way above the market average. This means that the stock would rise from around $300 per share today to almost $1,200 per share in 2031. If you enjoyed this video, click the next one for more.